Good evening, everyone. Welcome to our new series, which is Leadership Connect. And today we have with us George, who is our CEO and a CIO, and along with him is Senior Fund Manager and a Deputy CIO, Sandip, with us. Uh, we have been getting a lot of feedback from all of you, which is our partners and the clients who have got the monies invested in our fund. We really wanted to connect with you all and share with our thoughts the changes that we have brought in last since the time George has joined, and how do we see the portfolios shaping up from here further. And we are pretty happy to take if you have any further questions to ask. Straight away, getting into the discussion, George, while we are doing this webinar after a long time, and uh, and it's been close to 8 odd months for you with us in an ASK as well. With your 2 decades of experience that you are carrying, uh, looking at ASK, the portfolios, what is your initial thought? How has been the journey so far, and what are your initial impressions that you could gather looking at a portfolio? If you can share your initial thoughts.
So warm welcome to ASK, and it is wonderful interacting with all of you. I'm sure that you will have a lot of questions on markets. Obviously Sandeep and I will delve more into that and to make you better equipped to handle your clients' money, as well as many of our clients who have logged in. Definitely, we would like to give you more color on the portfolios and how we are thinking about the markets. So that is invariably one of the most important thing while we connected today to give a perspective on the markets. Last 7 months, and then we have been working on the portfolios and making sure that we have a good experience for the clients is the thought process at which we started. ASK, let me give the first impression of mine is that first the ethos at which ASK has been running the portfolios over last 3 decades plus has been phenomenal. As an outsider before joining here, when I was looking at the portfolios, the ethos at which ASK is able to pick and choose stocks, some of the big winners like Bajaj Finance, how many PMS houses can claim saying that they have been holding it for 15 years, right, and still bullish on the name, and so like that, many winners from a tiny cap to small cap to mid cap, which are seen to become large caps. Very few people will be able to claim that success, which is something which ASK is really proud of. And that is something which I could see what is happening when I was analyzing the portfolio. Secondly, the way we have approached investing and with ethics and with the diligence we have managed clients' money, ultra HNI clients' money over the last so many years is definitely the reasons why many of our clients are with us even today. We have created phenomenal experience of compounding, investing into good quality, high growth companies, right? So which is also very important to look at. So that is also is clearly visible when you analyze various years portfolios. And what we thought was, keeping the ethos of ASK in place. How can we make it better? With my experience coming on board, having worked in various places and asset management space, and also on the setting up the businesses and setting up investment philosophy or framework at hand. I have seen some of the big scale up exercises in my past tenure going AUMs in tune of 50x and 100x in terms of the portfolios. How do we create those kind of scalable format is what we were thinking. And accordingly, we have created certain investment philosophy and the investment management framework has well settled. So why 6 months later we are doing this call or 7 months down the line is main reason is that we wanted to set things up first in the way I wanted it to be, or the team wanted to be, and we created that capability in house. And now when we are talking to our clients and distributors, we are more confident about what the situation is. So we said focus investment philosophy should be the center, and we created a acronym called focus, which is more fundamental oriented opportunities and scalable opportunities we want to identify, cycles, business cycles we wanted to keep a tab on, and also the moat advantages of the competitive edge the businesses has we want to be clearly focusing on. And lastly, we want to look at the investment margin of safety. Whatever we invest, we need to buy cheap. So probably some enhancement was required in terms of the business cycle thinking, and secondly, in terms of the margin of safety. These are the two aspects probably I was bringing more focus on. Otherwise, all of them were already in place. When we look at from that perspective, some changes in the portfolios was required. We have made those changes, and we have been further enhancing it on a daily basis. And mind you, the last 1.5 years, markets have not been kind enough, right? So markets have been extremely volatile. Trump was making noise every day, tweeting all over the place, and we are having enough background for negative as well as positive surprises every day, right? So the journey has been phenomenal. The impression is that ASK will do very well going forward, and the portfolios have been restructured, positioned well in terms of the investment philosophy and the framework what we have set in. And my colleague Sandip has helped me in creating all these frameworks, philosophies, and we have worked extensively over the last 7 months to make sure that the clients' portfolios and are well in place.
So building on to what you just have said, which is looking at a framework, keeping focus as a way to build portfolio. But I'm sure we'll talk on the changing of the portfolio at a later time. But currently, if we would want to speak a little bit more on the investment team, you know, what are the changes in the investment team, both in the research as well as the manager's level, that you have brought in last 6 to 8 months that ASK as a unit has seen through? If you can highlight on those.
Yeah, the first change what we brought in is that we brought a head of research, Mr. Saurabh Patwa, who is having almost 19 years of experience. 15 years he has spent with HDFC Mutual Fund. He has come on board along with within a month's time of my joining. He has come on board as a head of research, and also we have revamped the research team. Currently we have a team size of almost 10-member research team who tracks majority of the sectors, and also we have enhanced the number of stocks that what we track. Right today, we track around Sandeep, we track around 450 odd names. 450 names. Yeah, 450 odd names we track, and which is extensively bottom up basis we track, and also make sure that we have the fair value estimates for every company that we track. And the team, the experience of the team, if I may say, two of them are out of 10-member research analysts. Two of them are junior members, one fresher CA, and another one who is only having 1 year experience out of MBA college. And all other members are having at least 7 to 17 years of experience range, right? So Kajal, who is looking at the banking sector, Vishal, who is having also looking at banking plus consumer sector, all of them are 15 years plus, 15 to 20 years of experience, guys. So we have a good breadth of skill set, CA rankers plus IM grads, as well as we have good quality research analysts who have come on board. That is the 10-member team we are talking about, which actually builds onto the research capability and the focus investment philosophy on one side. When we set up the philosophy, we need people who actually track and build onto the culture and the philosophy that we have built in. So to help the fund managers like Sandeep and other members in the team, we are having a very strong research team in place. That is a key message which I want to leave it with. Apart from that, we have a very senior fund manager Sandeep is a very, very qualified and senior fund manager working as a deputy CIO for the firm. Along with that, we have, Amit Nigam, who has joined in from Invesco Mutual Fund, who used to manage more than, $1.5 billion in assets, which is predominantly into large cap and, ESG infrastructure and, those funds who is also coming in with a lot of experience. So 24 years of experience. I am mentor pass out as well as IT rookie. So he's a very, very solid candidate who has come on board very recently. The announcement is yet to be made in public, but he's also helping us to build the take the investment philosophy as well as framework to the next level. So we have good combination of experience coming on board, be it the head of research, be it fund management, be it research analyst. Is a good bandwidth which was created in the last 6 7 months. So that is about.
So I think the broader message is from a people's perspective, whether it's for the manager's level or the research analyst. I think we are now well capacitized. And
Absolutely.
that's something that
Yeah, so we can manage, large scale AUM at this stage, and we were looking at like-minded individuals who can build, who have the right skill set, right attitude, to work for ASK and build it to the next level.
Now that takes me to a very natural question, which is natural follow-up rather, that with the team being there all set to get the best possible ideas, but the times are pretty volatile. Giving us a clue of 2017-18 when the portfolios aren't looking good, but the markets are on a different trajectory and pretty much looking like a mirroring the times of those. What would be your approach navigating through these tough and volatile times? And what would be maybe one or two messages that you would want to leave with our investors and the partners for them to consume? If you can just give a little bit of a brief on that.
Yeah, absolutely. This the most fascinating thing in markets is that every day it is challenging, right? So that's why I'm in this business. And also, as Warren Buffett says, tap dancing to work. So when I come to office every day at ASK or in my previous organizations, I used to feel that somebody is paying me salary to follow my passion. So that helps me to go. Every day becomes a very interesting day, and a lot of noise around. Be it tariff wars or be it rate cuts or be it various events which keeps happening and which keeps us, each one of us, Sandeep and myself, on toes. So the good part is the last 1.5 years market has not given any return. So that's a good part for an investor who is looking to invest now, right? Because if the market has been giving last 1.5 years also very good return, probably market would have gone into a very frothy situation. Whereas that is not the case. At least some solace on that regard. But if you look at the valuations, which I was, many of our partners who have been interacting with me even in the last 1 year, probably they would have always heard that valuation is rich, valuation is rich, valuation is rich. So that is the situation even today when we look at mid and small cap space. Why is that so? Because mutual funds are getting almost $3 billion in asset SIP, and that get channelized to mid and small cap stock, which monthly it is going into that space. People think that since the money is coming in monthly, that can support the valuation. But the answer is market is much bigger than what you and me think, and market has its own mind, and it will not. It is roughly, when I did some calculations and presented to the team, daily turnover, daily actual cash turnover is around 50,000 crores. Now it would have shrunk more. Out of which, if you want to potentially control the market or the price point, you need to have 20,000 crores per day, right? So if you look at the rough cash levels, 2 lakh crores or 2.5 lakh crores, doesn't mean anything. There is only 10 days or 12 days you can control the market, right? So beyond that point, the market cannot be controlled. Market has its own mind. If the valuations are extremely rich, market will not give you, it will not reward you. So that is the challenge. Most of the money being chasing mid and small caps, that is fairly richly valued, and earnings also is muted in the small cap space. Mid cap space, earnings have been decent. But in the large cap space, since FIs have been only sellers in the last 1.5, 2 years, that has become extremely attractive. So on one side, mutual funds are not putting money into large caps. Secondly, FIs have been withdrawing from large caps. Both put together, there is a divergence in valuations which was created, which is probably at a 2 decade high, right? The divergence is a 2 decade high, which means the crowding effect is more in mid and small cap, and the crowding effect is least in large caps. So today morning, one of our partners was messaging me saying that, where should I put money? So I told that, you should buy some of the Nifty 50 names. That is where that is a pocket which is looking attractive.
Yeah.
Large caps look much more reasonable to me. So from a 3 year perspective, how it will pan out, probably, people who are sitting on mid and small cap space, they will they'll lose their patience because SIP returns will become negative. It's already become negative. What I was told in many cases. And you will see the returns not panning out the way people have been thinking for 2 years, 3 years, 4 years. That's where the disappointment will hit it. So till that time, my call is to be in large capish companies. And that is how we have created certain portfolios specifically targeting that and generate returns over there. By the time people get upset in mid and small cap, we will move to mid and small cap at that point in time. So that is a broad thesis we are in.
So I think the messaging from the investment desk is very clear that large cap is the space where at least we do see a margin of safety being better. Risk adjusted returns are becoming a better as a proposition, and that follows me. A follow up question to you, Sandeep. While we understand that you are managing the portfolio, which is a lighthouse, and it talks about the core themes where we have our heightened conviction is what this fund would be investing, and this is also one of the core fund that we are looking at from a theme perspective. With the background of the view that George carries, that large cap is the space to be in. How do you take it further and build it on a theme side? What would be your thoughts on that?
Sure. In Lighthouse, we are primarily focused on three or four themes, and we would remain invested in those themes for a period of few years. Our current focus themes are manufacturing, infrastructure, energy, and defense. And we would be investing in sectors focused on these themes and all the associated and allied spaces. Uh, why we are bullish on these themes is because we believe that the next leg of India's transformation is likely to happen through these sectors primarily. So if we look at the top 10 economies globally, US is at $30 trillion, China is at $20 trillion, Germany is at $5 trillion, India is at about around $4 trillion, and then all the other economies are sub $4 trillion. The economy which has the best chance perhaps in the next 10-15 years to double or more, we would definitely say that India is one of them. And the sectors which are going to take India over there, we believe that manufacturing, infrastructure, energy, these are going to be some of the primary drivers. The way we have positioned the portfolio is that about 65-70% of the positions are in large caps, where we believe that on a risk adjusted basis, uh, there is higher potential for return as well as growth. Because the themes that we are playing are high growth transformative themes, the large cap names that we have bought have good earnings potential. It is not that because they are large caps, there is no growth. Actually, the growth profile of the portfolio is significantly better than the benchmark, which in this case is the BSC 500. So, Anunaya, we've concentrated our investments in these three or four themes. Uh, while we have 65-70% large caps, the mid and small caps that we've selected are those which are leading businesses in these sectors. Management quality is good, balance sheet position is solid, and the returns on capital of the businesses are also very good. And these themes have, in our view, a multi-year high growth runway in front of them.
So if I can just rephrase it, what you said the fourth theme where you have the best conviction today is a manufacturing, energy, infra, and a defense. Did I hear it you right, sir?
Yes, that's true.
There are four themes, and obviously the allied businesses which are like which
Sure.
are associated with them.
Yeah. This is for the lighthouse portfolio.
For the lighthouse
Sure.
portfolio, where I could see someone putting a message saying manufacturing hasn't done well last 1 year. So, sir, I think message is it's not about a theme; it's about the strategies and the stocks that makes a difference. So, we'll touch upon that part also in some time. But getting back to you, George, because you touched upon a very pertinent topic of searching for a valuation, which and you said it's in the large caps. We have a fund called a core, which is we recently we launched it. How are you playing that theme or that large cap market cap biasness in the core portfolio? If you can just highlight.
Yeah, and it's very interesting, so why we came with the core portfolio, better. The reason behind is, I was seeing, at heart, I'm a mid and small cap guy, right? So people who know me from the mutual fund industry, they know that, George is more glued on to small caps and mid caps. And I've run strategies in my previous stints in small and mid cap. And, we have returned money also at a very high returns. So I'm still glued on to the names, but I wanted to be positive on mid and small cap, but the answer is the space is looking very frothy. That's the only reason we have not been very bullish about it. But having said that, we looked at whether some of the large cap names are looking very, very attractive. The answer is yes. Some of the, like say, private banks, for example, it is trading at 5-year low valuation, right? So which is looking very, very lucrative to us. Probably next 3 to 4 years it can double, right? So when you see those opportunities, we have to harness it, right? So that is where we thought, can we create a portfolio? Probably Nifty 50 has a mix of lot of combinations, consumer, IT, telecom, retail, and many things. Is it possible to create a 10 to 15 stocks portfolio which can potentially outperform the large cap index, Nifty 50 index, in a reasonably good fashion in the next 3-4 years, in the context what we mentioned earlier, that small and mid cap will reel through the pain, and it will take time to recover. The earnings recovery will take time, and the money to come back into that segment will take time. So during that phase, can we create a good experience for clients, creating a 15 stocks large cap core portfolio, which ideally a client should have in their portfolio, right? So creating a 15 stock core portfolio, the thought is it can be a core part of the client's portfolio. And at a time, and what we mentioned in the presentation, if you read through Anunaya, is at a time when we see there is an opportunity in mid and small cap. Maybe I think it could be, unless otherwise there is a big correction mid and small cap immediately, it could be a time correction.
Yeah.
But whenever that happens and we see there is an opportunity coming up, 30% of the portfolio will skew towards mid and small cap at that time. That's what we have mentioned in the presentation. So it is, in a way, will look like a flexi cap.
Sure.
But today, the portfolio, if you look at it, is more like a large capish portfolio, which is having only 15 stocks, large cap names, which the distributor or a client will not find it difficult to believe that these are good companies, and can hold on to the portfolio as a core holding. And at a time when it is looking very attractive, we'll move the money, 30% of it. 70% still will remain in the core large cap holding itself. So it is a very stable product that we are offering to the client, and with no legacy, nothing of that sort. And the clients can easily allocate money into this product. So that's why we came with this portfolio. And obviously, we have other strategies existing in ASK basket, which has gone through its own, different cycles. performance cycles. And probably this is a product, core portfolio, core strategy, which you have come up with no legacy, no baggage, very clean 15 stocks portfolio, which clients can onboard.
And a strong tailwind, if institutions are going to come back to India for whatever, headwind that they see globally,
Absolutely.
then I think large cap is the best place to be in.
Absolutely.
And I think the key point in the core is also the active weight that you can demonstrate because of the conviction that you can
Right.
have.
So there was one comment, one of the message I could see that what is your view on IT sector? Right?
Okay.
So I personally believe that the team, when we do the bottom up analysis, all along we have been negative on IT sector.
Yeah, I remember.
Right? So if you remember, ASK portfolios had zero IT all along, or very less IT exposure. But looking at the balance of payment issues which is currently coming up because of FDI being negative and FI flows being negative and the trade deficit going up, we realize that there is a possibility of INR depreciating. And we have put out a note also very recently saying that this is the best time probably look at IT sector. And if you see the core portfolio, we have increased one of the IT names, large cap IT names, is a key holding, and that has been recently done after such a long period of underperformance.
Very true.
So we are very positive on the large cap IT names rather than mid and small.
Yeah, and core will never have more than 15 ideas.
Yeah, will not have more than
at any point.
at any point.
Wonderful. Now let's move a little bit from a large cap to a flexi approach, and we have a fund which actually ASK has showcased a lot of innovation into it. I'm talking about IEP, which is broadly looking at the fund where entrepreneurs have the heightened higher holdings and their skin in the game is more and more. And also where we have most of our clients and their distributors, the monies are invested in that fund. So any thoughts on the changes that you have brought in, both on the number of stocks, on the sector allocations that you would want to highlight?
Yeah, predominantly this fund used to run with 30 odd stocks in the portfolio, and that remained as it is.
Sure.
But the endeavor is that can we move to a 20 stock portfolio at some point in time, right? Being a large portfolio, which is having more than 10,000 crore in assets in that portfolio, the way I have been changing the portfolio is mainly to look at the cyclical sectors which are poised for growth. Some bit of it will be part of our lighthouse portfolio also. Can we create some of these portfolios into reflect the cyclical benefit of it? So when we said focus investment philosophy, which you mentioned, the business cycle should be very much relevant, and we see that the entire investment cycle is picking up. The capex to sales for BSE 500 companies has started moving up from FY22 onwards. We are seeing that the banking sector, especially the PSU banks and one of the largest private banks, have seen a massive recovery cycle in the last 5 years. Now, credit growth started picking up in the last 2 fortnights. We see there is a credit growth pickup possibility, and we have very nice situation emerging that the inflation is low, interest rates is low, the corporate balance sheets is cleaned up, banking balance sheet is cleaned up, and therefore there is a long runway for growth possible. It is very different from in the year 2000 when the capex cycle picked up. So to my mind, it is a good launch pad for growth which is coming in, which we need to capture, and that's where some of the cyclical sectors like banking sector, auto ancillaries, and also maybe hospitals, all these are looking extremely more domestic oriented cyclical sectors are looking very attractive from top down as well as bottom up basis. That gives us a comfort saying that this is where we need to position our portfolios. It is not because of the Trump trade war. We have been positioning it 7 months back onwards, and eventually today some of the green shoots are visible, in terms of the returns, right? So November, for example, the fund has outperformed by 1%. And slowly it's kicking in, the green shoots are visible. First 3 months we were thinking about the strategy, how to revamp. Now it is showing some color.
So if you can also highlight what is your market cap distribution in IP right now?
So IP approximately have 80% in large caps.
18 large.
Yeah, and 20% in mid and small cap.
Okay.
And those mid and small cap also, if you look at many stocks have been beaten down to dust, over the last many years, and people have no hope on these companies. Therefore, it is completely out of favor names which you will see. Even banking names, some of them which I have never invested ever in my career, some of them we have started buying because the governance has changed, the business models have changed, and also there is a management change, and also the valuations have changed, right? So if you look at those aspects, especially the margin of safety, keeping in mind the margin of safety aspect, and plus the good runway for growth, many of these stocks are looking very attractive, and that's what we have built in our portfolio.
Perfect. Perfect. Uh, you did touch upon a part on a BFSI, while you were talking for the IEP.
Right.
While we have a fund which is an FOP, which is predominantly a theme-oriented fund looking at an opportunity in a BFSI segment. So would you really want to elaborate a little bit more on the BFSI, why you feel so, excited and so convincing on this as a sector, with a background that if I would go back last 4 to 5 years, this sector, despite having the highest weight on the Nifty, hasn't contributed. And we have a fund, and that fund actually has done a phenomenal. If I look at the return of the fund across the time frame, it has done amazing returns. So, would you two questions? One is, what is your more, I would say, elaborate view on the BFSI? And second is, would you recommend FOP at this point of time? Well, it is a part of our satellite allocation, but would you still recommend it?
Definitely, Anunaya, if you ask me, the last 7 months, the fortunes of that portfolio has changed dramatically, and now it is looking like long history also has been corrected, and that's what will happen in other portfolios also, right? Sudden last 7 months good performance has changed the history for FOB as well. So if you some of the funds Sandip is running or myself running, you will see this change happening because it's a concentrated portfolio. So the moment we make some changes, and if it is working in our favor, suddenly the fortunes will change. So to my mind, FOP, the portfolio, uh, ultimately it helps the stock picking part. We have two BFSI analysts in our team at this point, Kajal and Vishal Putka. Both of them are very good analysts. And what we have done is that the 6 months, 7 months back, we thought when we looked at the bottom up basis, we realized that the MSME SME segment is looking extremely attractive. The banks which are focused on that, because they have gone through almost 4.5 5 years pain, right? And it is available at a ridiculously cheap valuation. Those stocks actually helped. We picked it up. Exchanges were another one, like the MCX and BSE were part of the portfolio, which actually benefited a lot. Some of the MFI players, microfinance players, which again had gone through a rough phase, we realized that it is coming back to normalcy, and which was visible in the, if you listen to the calls of HDFC Bank and Kotak Bank and ICICI, all these, the banking calls, the quarterly calls, they were also indicating that some of the pain is behind, right? So which was visible, and we made those changes, and we took a reasonably good weight in these stocks, which has turned the table differently. So what we were looking at is a very cheap or attractively valued sector at this point in time. When I look at from the overall market perspective, that is the one sector, the BFSI space is one which is looking very attractive.
Sure.
And it is beneficiary of, if at all, GST, what we talk about, rate cuts, we talk about, real estate improving, what we talk about, or aspirational, spending, which we talk about. Everything ultimately will have a multiplier effect in the banking space. So and plus the corporate loans and the capex story, what we talk about, everything is linked.
And their balance sheet being so clean.
The balance sheet is squeaky clean today, and and the recoveries have been phenomenal.
Yep.
and we see that that is one sector which is attractively valued relative to the market. It's one still some of the large private banks even today is available at one standard deviation below the mean, which I think it is a brilliant opportunity to pick it up. And even today, we are extremely convinced to allocate money into a banking and financial services sector. So this will be a good product where clients can look at. So the way to put things in perspective, the way we look at it is that core and IEP are the two large cap biased portfolio today we have at ASK, and Lighthouse and FOP are the two satellite portfolios what we have, which clients can look at. So if somebody were to allocate money, they have to allocate money depending upon what the advisor is saying or the client risk appetite is. But if I may say on a ballpark basis, if 100 rupees being allocated to these portfolios, at least 70 should be to the core and IP, and 30 rupees to be to the FOP and Lighthouse.
You just answered my follow-up. I was actually going to ask you the same thing. If we have to look at the four fund that we have spoken, how would the allocation would you recommend? And you just answered it. I think Sandeep, George did touch upon the flexi cap approach in an IEP. We have another fund which is pretty much a flexi cap oriented fund and on growth, which is one of the oldest fund as well that we do have. Uh, and that fund is currently getting managed by you. So why would you would you share your thoughts on the growth fund? Again, in terms of the changes that you have brought in of late, because again we have started noticing the green shoot in the fund on the performance side. So what are the changes that you have brought in which had led to a desirable, outcome that we are noticing?
Sure. So the growth fund is actually a diversified play on the overall India growth story. What we've done in the last few months is we've concentrated the portfolio into about 22 positions. Earlier, the fund used to have about 30 stocks. That is the maximum number of stocks that we would like to hold in the fund. But now onwards, the number is more likely to be towards 20 than towards 30. Also, currently, the fund has about 78% of its position in large caps. So that is the second change that we brought about. The third and the most important thing that we've done is we have repositioned the portfolio to benefit from a domestic cyclical recovery. So what we are relatively more bullish on is the domestic growth environment. So about three-fourths of the fund is leveraged to domestic growth. We are relatively not as positive on global cyclicals or domestic defensives, sectors like staples. So our fund is now designed to benefit from what we believe is going to be a cyclical uptick in growth from an earnings standpoint. If we look at the key psychographics of the fund, then the fund earnings growth is significantly better than that of the benchmark or the overall market. The return on equity is also better than the market. The balance sheet leverage ratios is comparable. The management quality and growth runway is superior, while from a valuation standpoint, it is just about 10% more expensive optically speaking, but adjusted for growth, management quality, better medium-term growth outlook, we believe that the fund is actually attractively valued. So these are some of the key changes, Anunaya, that we've done over the last few months.
Oh, that's wonderful. And if I ask the same question that I asked George, well, we do call it a flexi cap, but what would be the distribution of market cap in the growth?
Sure. So in growth, currently about 78% of the portfolio is in large caps, and the balance is in mid and small. As George said, we don't have a specific market cap allocation in mind for a particular fund, though we have for flexi cap funds a minimum and maximum levels defined for each sectoral market, for each market cap segment. Uh, as and when we believe that there are good, worthwhile opportunities available in the small cap basket, we are more than happy to buy those names. And then perhaps maybe could a few months down the line the ratios be different? The answer is yes.
So I think one consistency that I could see with talking to both you, George and Sandeep, that our biasness to large cap is well, understood, and we are well casted rather. I think we are pretty clear in our mind that we wouldn't want to go overload the mid cap, and you rightly mentioned because you are not, despite you being a mid cap specialist, and that's your favorite space to be, but you still maintain that this is a time when we should maintain a little bit of a large cap. Uh, we have another fund which is a golden decade. We call it a golden decade or an India vision or an DRP, where I think sometime back we got a lot of money also moved into the fund. This again is a fund which is large in a mid kind of a portfolio. Uh, what would be your thoughts on the fund, and more in terms of how is the fund aligned or structured today, taking in mind the outlay that you have just given on the markets and the opportunity which is building it up. So how do you
Right.
see golden?
So, it is an interesting product, where we had to admit there was a lot of performance impact
Yeah.
in this portfolio, and which has not played out the way it should have been. So, what we have done is we have taken a very closer look, and this was the first product where the complete revamp was done.
Okay.
Okay. So, we have looked at the portfolio very carefully, and we have made the changes. In a PMS construct, when we are making the changes, we know that it impacts capital gain also. So we have been very mindful about that aspect, even though when we want to make the changes, because whatever changes, if we don't make, it is not going to benefit the fund in the next foreseeable future. So today, as we speak, we have only 20 stocks in the portfolio.
Oh, lovely.
Okay. And it is well concentrated. The expectation is that next 18 months to 24 months, the portfolio should generate disproportionate alpha over the benchmark to cover up some of the lost ground which we already have. Right.
Sure.
So I am pretty hopeful the way the portfolio is positioned. It can generate very good alpha in the next foreseeable future. And whenever I have seen, since I have managed PMS in the past, and when we concentrate on a 20 stock portfolio, the recovery can be significantly higher. So even a given time of 18 months, you will see the results by yourself. And as we speak, if you look at the last 3 months, consistently it has been an outperformer.
Yes.
And the results of what we have done in a very short span is visible.
Yes.
And you will see that accelerating over a period of time. So hold on to the portfolio is my call.
Okay.
Don't change, don't shift, because we have made the shift in the portfolio for you not to shift. Right. So keep holding the portfolio, you will eventually get the benefit of it.
No, I think George very well articulated, and I think as I said, uh, it's always in the returns and the green shoot that we do see. So as you mentioned, it's already started getting visible. Uh, we have another fund, which is our EOP and an EOF. Now this is way different from at least the positioning that you have done in the call today, which is to maintain your large cap biasness. So this is a fund which is just opposite to that. This fund looks at opportunities in the mid cap. I also heard you talking some time back saying that look, mid cap is not a space which is touch me not. You would need to maybe work a little harder to find your own solace and see to it where the opportunities are emerging. What has been your approach while managing this fund?
So, concentration is a game in PMS.
Yeah.
Right. So what we have concentration and personalization. If the client is coming up with some money, and if you need to create a portfolio in mid cap, you should be able to create a portfolio in mid cap. Mid cap space is having 150 odd names as defined by SEBI, and small cap space is much more larger. So what we have done is we looking at the frothiness in the space. We need to pick and choose which is more attractively valued.
Yes.
Right. Because if the money goes out, money will go out from the frothy names and not from the attractively valued names. Attractively valued names means people are less owning it, or people are less positive about it, and people are less holding it, right? So we have gone through, say for example, I'll just take an example. What we have, it is not a stock recommendation per se, but what we have done in the portfolio, this one stock called IEX, Indian Energy Exchange.
Yes.
Before when the coupling news came in, the stock was down 35% in one day, right? So prior to that, we have started nibbling. We had 1.5% in the portfolio. After the 35% fall, we were already prepared for it. We knew that this is supposed to, if it happens, because it's already on the public domain, that this coupling can come. Once we analyze, we realize that it looks like a sitter buy, right? So we bought almost 9% of the portfolio today is in. So that's how we are concentrating the portfolio. It is a gradual process. The results is yet to be seen, and some green shoots are visible, but it's very early stage. But what I can say is that what we are building in the portfolio, with concentration, what we are building, it is going to create the the biggest difference compared to any mutual fund mid cap fund or any other mid cap fund. So it is today as we speak, almost 97% of the portfolio is into mid and small cap.
Oh wow.
Okay, and we are believing that it will be a 20 stock portfolio by in next 1.5 months time, or next 2 months time. Before the next 2 month fact sheet you look at, you'll have only 20 stocks. As we speak, there are only 23 or 24 stocks, which we are further concentrating, making sure that we will have only 20 stocks, high conviction, mid and small cap bets, which will have almost 60 to 70% will be in mid cap, and 70% and 30%, 20 to 30% will be in small cap, and that should give it again. The performance recovery will be visible over the next 1 year's time frame. So I am very hopeful about picking and choosing the right ones in the portfolio. So it is always a stock pickers market. And if you are able to pick the right ones and hold on to it, you will have tremendous alpha can be created related to the benchmark. So Sandip and the entire team, we all are together brainstorming with a. So now the investment team has become so large, it is not fitting into the rooms what we have right now. So we'll brainstorm more, pick and choose the right ones, and we'll build a portfolio which is very solid. So somebody who is having a 3-year plus view, and you can hold on to the volatility in midway. You should look at EOP also, but it is not everybody's cup of tea, right?
Yeah,
so people want consistent returns all points in time, and in mid and small cap comes with a lot of volatility.
Well, yeah, that's right. So I think somewhere you mentioned that we are currently, positioning 4 of our funds as a recommendation. While everything is looking good, but 4 are the very key ones as a focused. And we spoke on core, which is the large cap bias, 15 stock strategy. We spoke on IEP, which is more of a flexi cap, but looking at investing in opportunities where entrepreneurs holdings are higher, and 2 on the satellite. Like one is lighthouse, where we will at any point of time never go beyond 4 of our preferred themes, or in FOP, which is more of a thematic BFSI, and you have just mentioned the reasons for that. Like someone has to invest money in these 4 ideas. Maybe you would want to pick one fund or a combination of 1 or 2 funds. At time of today, would you recommend a staggered approach of investing, or would you say that someone go the lock, stock, and barrel, or maybe at a certain fund you feel staggering will make more sense, a certain funds staggering may not make sense?
So the large cap bias funds like EOP, IEP, Indian Entrepreneur Portfolio, which is investing into high quality promoters run businesses, where and plus the valuation is looking very attractive. For both has to come together, and where we see there is a change and visibility of earnings and the business cycle changing for these businesses. That is one product, and plus core portfolio. These are the 2 large cap bias portfolios where there is no staggering required. You can put lumps. That is my view. And it depends upon the client's appetite and all those things. It has to be thought through well by the advisor or distributor. But at the same time, if when you're looking at an EOP, entrepreneur, emerging opportunities portfolio, which is more mid-cap biased or those kind of portfolios definitely need staggering. At least I would say when the valuations are extremely rich, like mid and small cap space, the staggering should be at least, 7 to 10 months. Whereas in the case of, Lighthouse or in the case of FOP, the time to invest is now.
Exactly. That's
So
what
we cannot, there was a period where I was suggesting staggering in Lighthouse.
Yeah.
But today, to my mind, since the stocks have underperformed, there is a real pain in the portfolio, portfolio stocks, many visible. And recently also many stocks have corrected because of various reasons, tariff impact and so on and so forth. This is the best time to pick and choose and put lump sum in these portfolios. So core, IEP, Lighthouse, and FOP, I would be happy to receive lump sum in these portfolios.
Yeah.
And staggering is mostly needed in a mid and small cap approach.
So, George, if I read the market and I bucket them, and my bucketing is based on ROE. So ROE is being more than 15 and ROE is being less than 15. And markets have given a very fancy name. Someone called ROE more than 15 growth, ROE less than 15 as a value, so on and so forth. And we have seen pre-COVID, post-COVID, the eras have changed. The ROE more than 15, which were in the flavor pre-COVID, lost their attention in post-COVID, and everything where we couldn't establish the earnings as a proposition created wealth. Somewhere we also lost because of our quality being the focus for us as an house. Now, my question to you is, are we back in the era of pre-COVID? Wherein my question is, are we now in a space where we can say that looking at the valuations, market participants are looking at better predictability on earnings when they would want to build portfolio or create wealth? Are we back in the pre-COVID era?
Anunaya, you would know that I've been, whichever client interactions I had in the recent past, maybe Sandip also would have done it, So all the meetings, I have taken one slide with me, that is the presentation slide, which talks about the last 35 years investment.
Decadal shift.
Decadal shift, right?
Oh, yes.
So 1990 to 2000 was a technology, media, telecom rally. And that rally consummated with the dot-com crash in the year 2000. Then you saw a infra rally, which consummated with the global financial crisis. And then you saw a consumption rally, which concluded with the 2020 COVID crisis. So after every crisis, the sectors and the themes which works are very different.
Yeah.
Right. So 2020, in my mind, it has marked a bottom for cyclical sectors.
Lovely.
And peak for all the so-called quality, high ROE sectors, and which is continuing today. And it coincided with, if you see the macro backdrop,
yes,
it coincided with a low inflation and zero interest rate scenario in March 2020 to a high inflation scenario in US. And global inflation has moved to 3% in US. In a scenario like this, the FMCG sector, pharma sector, all these to perform becomes extremely difficult. So to my mind, this is a marked shift from a high consumption oriented cycle to a cyclical, capex oriented cycle. Not in the same fashion as 2003 to 7, the capex is happening, but in a very different fashion. That's why we are very bullish on the Lighthouse portfolio.
Yes.
We are seeing that the manufacturing and capex started picking up, and that is the cycle we want to play in our ASK portfolios. And if you don't mind, if you are not mindful about the decadal shift, you miss a decade, right? So 2020 onwards, even till now, and going forward in next 3-4 years, you are going to see the cyclical rally decade. right? So it is not to pre-COVID era. Pre-COVID era, whatever stocks have been performing, you would have heard about various terminologies like, the stocks are good compounders, but ultimately, and they are consistent compounders. But you have to remember that, no tree grows to the sky.
I agree.
Right. And 2020 onwards, these stocks have been a massive disappointment for many of them who have bought into the COVID crash also. Like people went and bought Asian Paints, people went and bought all these stocks. They are not performing. The reason behind is the earnings peaked out, margins peaked out, valuation peaked out. And today, as we speak, the same sectors which were darlings of 2010 to 20 are not performing, and they are at a severely overpriced, overvaluation zone even today, because HUL in the last 5 years has not given any return.
True.
And it has not generated any earnings also.
Yeah.
So if the earnings have not compounded, and then there is no case for looking at it favorably. So to my mind, we are not in the pre-COVID era. We are in a very different era. It's a inflation protection era. The commodities are doing well. The risk at real estate will do well. Capital goods engineering will do well. Financials will do well. If we are not in this space, we are not in the game, right? So we have aligned the portfolios to meet the cyclical requirements, and that is what we have made the changes in the portfolio.
One interesting question, George, which is, I think, however, and Sandeep, you touched upon that topic, which is the size of the opportunity, and you mentioned about America being one of the largest economy, and we are seeing a signs of weakening of an American economy. Uh, the question what I wanted to really get a sense from you is, do you see America as an opportunity or a tailwind or a headwind when we look at India? While domestically, if I look at, I can talk on 120 tailwind, which is supporting our economy. But one of the headwinds that we all get worried are the global phenomena. Now, for a second, I don't want to get into cross-border escalation. Let's keep that aside. Looking at the big daddy alone, how do you see India, building themselves? Well, I know you have also been a great proponent of talking about a transition from a service to manufacturing, and that's really one of the key themes that we have in our lighthouse as well. But besides, how do we see us handling this bit?
Yeah. So the interesting part is that in US, US has been the biggest beneficiary of the growth engine because of the tech companies, right? And last 12 years, they have phenomenally benefited, where we were doing a lot of changes in our structural uh, factors, like say Demon, we did GST implementation, RERA, a lot of structural changes we were brought in during the space, and therefore we actually suffered growth, whereas US was growing, right? And mainly because of the tech-led growth. Now that is getting to a fag end, right? To me, it looks like the economy is poised for a significant negative surprise, right? In terms of the positioning of dollar itself. So any country, if you were to look at, and if the fiscal deficit has gone through the roof,
Yeah.
or the debt levels have gone through the roof,
Yeah.
or current account deficit has gone through, those currencies have collapsed in history, right? Be it Zimbabwe, Argentina, you look at any of these, and even 2013, the taper tantrum period, India was also facing the twin deficit and INR collapsed.
Yes.
So that problem is staring at us. How they are going to the tariff, whatever, when we talk to the currency experts or when we talk to many people, we are not experts on currency, but what we understand is that this is not going to tariff is not going to help these problem what they are staring at.
Sure.
So to me, from US becoming from a developed nation to a fragile economy is looking very likely, and people are moving away from dollar, and that is where you are seeing the gold and silver becoming more best beneficiaries, and central banks are preferring those, and that is why it is creating ripples in silver and gold. Now, coming to from our perspective, how we look at it is that India is in a sweet spot.
Yeah.
The interest rates are low, fiscal consolidation has happened, balance sheet cleanups have happened, interest rates have cut, GST cut has happened, eighth pay commission is staring at us. So there is a massive economic recovery cycle which is going to benefit us, which is visible in the recent festive season recovery also, which all points to the fact that there are many sectors, domestic oriented sectors, which are looking like auto, banks, and all are going to benefit out of these changes. And if we get a trade deal through, right, and which is also impacting the sentiment as well as the exports. If we get the deal through, I think a big fillip in growth will be visible in India, and the money will come back. Now the INR is depreciated. It is 91. I saw today.
91, yeah.
Now what will happen is that FIs who are looking to India as an expensive currency and expensive market, now they will start thinking that India is a better place. Now currency risk is not there.
Not there.
So maybe the money can come back, and that's where we think the money will come back into large caps. And generally, if you have seen, whenever money has come back, IT and banking has done very well, and which is where core is well positioned to capture that. So most of our portfolios, we are on a domestic recovery theme is what we are playing. Maybe we have added a little bit of IT recently, but mainly we are focused on the domestic recovery theme. And we are actually worried about the US fragile situation, how they are going to deal with it. It is their problem, but at the same time, it can impact us in the near term. That is the biggest risk in terms of any global sell-off which happens, which has happened. Most of the sell-offs in India has happened because of US, right? So next sell-off also most likely will happen because of US, right? So having said that, we in large cap space, last 1.5 years underperformance, not gone anywhere. Market has not gone anywhere. The stocks are becoming cheaper and cheaper as the earnings is coming through. We are looking at a good state of affairs to invest into large cap stocks at this point in time. And portfolios, most of our portfolios are biased towards large caps. And I might say that it is in a very nice situation we are in, changing our portfolios predominantly from mid and small caps to large capish portfolio, which is looking very solid at this point in time.
So I think I'll just add to one point that George just mentioned. If I look at the ownership pattern of large cap on a 2 decadal, we are below the median. Well, the median is at 58%, all time high is 64, our ownership is just 50%. That itself talks about the kind of opportunity on the ownership also that leaves there. I think it's I think pretty well elaborated discussion, nicely put across in terms of the changes that we have brought in and how well are we ready to take any direct global headwind that comes in, which to us there would be a headwind for them, but possibly a very strong tailwind for us. I think that speaks volume.
One question, Anunaya, probably Sandip can dwell more from the benefit of the viewers, is on the sectoral earnings, how the earnings have panned out.
Oh, yes.
And, how the different sectors are looking at. And, what is your observation from different sectoral earnings growth?
So, from a sectoral, from the market's overall perspective, what we think is that the second half of the year is going to be a much better experience for earnings growth. If we look at the year FY20 to 24, actually FY21 to 24, India had an earnings growth of about 20%. I'm talking about the index. Honestly speaking, those times are behind us. FY25, we saw an earnings growth of about 5-6%. FY26 so far, the earnings growth estimate is about 8 to 9%. The first half of the year has been about a mid-single digit kind of a growth. The second half of the year, we are looking at an earnings growth of about 10% or so. which is then going to build on in FY27 and onwards. So FY27 onwards, we can expect 13-15% kind of earnings growth for the market overall. So the Q2 from an earnings standpoint was perhaps a bottom quarter because we had about a 2% kind of an earnings growth. And H2 onwards, we will see a pickup. We will see good earnings, stable earnings coming from, let's say, the financial space. We are positive on the private sector banks because over there, valuations are attractive, credit growth is picking up, and margin normalization is likely happening in the current quarter itself. Um, Public sector banks also select names we are positive because again valuations are attractive and they are perhaps going to be one of the biggest beneficiaries of the pickup in financing in the manufacturing, infrastructure, and energy spaces. Automobiles continue to be having a good growth on the back of GST cuts, income tax cuts, and perhaps the medium-term story gets built on due to the 8th pay commission payouts that will happen, in the next couple of years or so. If we look at some of the other sectors like capital goods, defense, we see the ordering activity picking up uh, in the next few months. We believe that the government is now stepping up on the reform pedal. What we saw with GST reforms, then we saw 100% FDI in insurance. We've seen opening up of the nuclear sector to private enterprises. We've seen notification of the labor codes. So this is a sector where earnings visibility improves when ordering and tendering picks up. So, that is a space which we are positive on from an earnings standpoint. We are in a strong construction period for India. Generally speaking, December to June is when major construction activity happens post the monsoons. Excuse me. So cement as a space is looking good to us. We are quite bullish on the entire construction materials arena. As George said, from a tactical standpoint, we are positive on the IT space. While over there, earnings growth per se is not going to be that high. It's going to be in the mid-single digit kind of a range. But they are beneficiaries of, let's say, attractive currency. Valuations are attractive, and we believe that this is a good time to enter the sector. Uh, FMCG is again going to be a mid-single digit kind of an earnings growth. So consumer defensives per se we are not that positive on. We are relatively more positive on consumer discretionary, where we believe that medium-term earnings growth outlook can be very good. On the real estate side, while that's a sector which is more driven by pre-sales, earnings growth could be good because a lot of the sales activities that happened over the last few years are now going to convert into construction and hence earnings. Telecom is another sector where, because of the rise in ARPUs, etc., and capex intensity coming lower, we will see good earnings growth and good free cash generation.
Good. So it's interesting. So, the way I would summarize, the whole discussion from a investor perspective, who is looking to, is a client who has joined the call, and probably we can take more questions if it is any. Some of the firstly, this ASK. It is a complete change in the way we are running the investments. And investments is at the core of the business. So we want to manage the client's money very efficiently. We admit that there is some change, some impact in performance in the last few years, which has impacted. It's mainly because of not embracing the business cycle well. Right. So we have seen the railway and the government capex picking up, and we didn't react to it effectively. And that is a change and agility which we have brought into our investment philosophy. And we understand that, we have been managing clients' money over the last 35 years. We know where exactly we have gone through these kind of pivots, multiple points in time. And this is a pivot which we are taking in terms of investment philosophy and, also meeting the VUCA world, right? So the completely volatile, uncertain, ambiguous world we want to deal with, and we have changed the investment philosophy. We have changed the portfolios. The results are started to visibly come across, and we have increased the bandwidth in the team, and we increased the coverage of the universe from 80-90 stocks active coverage. We have moved to 450 stocks coverage, and also the you have come on board and to head the entire sales and distribution. And there, so we have a bandwidth created in investments, sales, and also the ability to react to market situations are much more clear right now because of the ability of our team, which we have put in place in terms of investment management framework and the philosophy. So I am super confident that this is a new ASK avatar we are seeing
3.0.
3.0, and also we will see a very different way in which the portfolios will start shining.
Absolutely. So I think on this note, as George rightly concluded, whether it is about portfolio managing or defining our engagements, you would see a very different ASK 3.0 that we just spoke about. This is just one of the many series of connecting with you all under the property of a leadership connect. You would see us coming back very soon with some more updates on the portfolio and on our thoughts on the markets. And in case we see something which needs an immediate connecting with the team or with you all, we wouldn't mind even making it faster. On that note, thank you for your patient listening and thanking for being an audience to all of us on the evening. Thank you. And the teams are pretty much there with you all. Feel free to connect with them or write back to us. We are pretty happy to respond back. Thank you.
Thank you.
Thanks a lot.
Thank you, everyone.
Thank you.